So we'll start tonight's panel with Kenny. He'll go back to history and look at some of the investment bubbles that happened, what we can learn from them, and whether there are signs of such irrational exuberance in today's markets. Kenny, please.
Thank you, JP. I suppose I'm the oldest amongst the panel speaker here. So it may be most appropriate for me to bring you back to history. And again, you can guess my age by looking at how I can tell about the history. But first, let me just share with you. Next slide, please. Four of the most dangerous words in investing. Every time you hear people saying, this time is different. I've heard this over the past few crises, and every time there will be excuse telling you, how different it is this time. That's why the market should continue to go up. Let me first take you back to when I first started in the industry. Next slide, please. I actually started in 1991 as a treasury analyst, and had a good few years when the ASEAN market, at that time, the in markets are not the North Asia market like China, they are the Southeast Asia markets. They are the kingpins. They were the kingpins then. And that time, the market was doing very well. And again, because of low US interest rates, a lot of the corporates in the Southeast Asian countries are borrowing a lot of cheap US dollar, convert into their respective currency, and some of the currency are pegged against the US dollar, so there's no exchange risk in a way. But then when US start raising interest rate in the 1996, 97, everything just unwind, whereby a lot of the exchange regime broke down. It started with the Thai baht, followed by the Korean won, Indonesian rupiah. And what happened was panic just spread across the market, and as a result of that, the market collapsed 67%. So that was one of the darkest moments that I've experienced. Then let me take you to the next slide, which basically shows you perhaps somewhere closer to perhaps a lot of you out there, the .com. That was in year 2000 to 2002. I remember that time, if you are not aware of any .com startup, then you are not considered as a acute investor. I remember even Warren Buffett at that time was kind of like being challenged as, your investment approach looking at fundamentals, is it too old-fashioned? And a lot of those .com companies, they are flush with cash, so money comes very easily to them. Liquidity was very abundant in the market at that time. And look at what happened after things unwind. The market crashed close to 50%. And a lot of them, what we call the .com company, they have no revenue model, they have no P&L, and they were just an idea, a hope. And a lot of them had their bubble burst. Then I think forward to 2007, the global financial crisis, I believe a lot of people here would have experienced that. Again, that was an era whereby, money just flow into, and it's more prevalent in the US market, whereby the housing bubble was created. I mean, everyone in the US just believed that, the property cycle will just go one way up and it will not collapse. And a lot of, investment were being structured in such a way whereby, the collateral debt obligation, which is in a way, trying to bundle up all those housing asset and then try to sell it to investors. Again, that unwound and the market collapsed more than 50%. And that was, again, you can see some of those big companies like Lehman Brothers also going under. The next slide. So right now, I think after the GFC, everything seems to be very smooth sailing. In fact, the market has gone up 400% since the GFC. And in the middle, we have a bit of a hiccup along the way. In 2018, the ex-president of the United States, Trump, had a big kind of fight with China. So the trade war actually triggered some correction in 2018. But that correction was only about 20%. So you wouldn't even call that a bear market. The scare actually came last year, in the beginning of last year, whereby the COVID pandemic struck. We are still, unfortunately, in the midst of it. And the market, as a knee-jerk reaction, fell 35%, but recovered very, very quickly. Again, helped a lot by the central banks, helped a lot by the low interest rate environment that we are currently experiencing. So what I'm trying to highlight here is that, over the past 3 decades that I started my investment career, I've actually seen 3 major crises. There are 2 more minor ones. I don't even call the COVID one a crisis, because before I get to be afraid, I do a lot of adjustment, the market start going up again. So what I'm trying to alert investors here is that, there will be times whereby the market will suffer corrections, and I think it's important for you to be prepared for it. And in the next slide, what I'm trying to illustrate to you is also some of the signs of irrational market exuberance. What Alan Greenspan words is like, what we are seeing, for example, in the crypto world. My colleague later, one of the panelists will illustrate a bit more. People flopping into crypto, the volatility that we have seen here. I'm glad to see the poll that, not a lot of you believe in crypto and kind of never participated in it. And then the likes of the meme stock, whereby, the likes of GameStop, AMC, those are the ones that the retail investors, or what I call retail traders, like to play with. There's also ways to raise money out in the market. The likes of SPAC, special purpose acquisition, company, whereby it's like a blank check company. They raise money from IPO and then they merge with some unprofitable company, and they can go. In the past, we used the term backdoor listing for that. So I think what we are seeing here is that there are definitely quite a bit of signs of market exuberance. But more fundamentally, what I think is more concerning to me is actually, there has been a lot of ignoring of some of the inflationary threat that is coming out from the market. You look at the commodity price. The current commodity prices are at all-time high or close to all-time high. The previous all-time high was back in 2011. And the investors, a lot of investors out there are assuming that this low interest rate environment will stay forever. And as a result of that, the central bank will continue to pump liquidity. So that, to me, is also a kind of a sign of exuberance. And last but not least, when your son or daughter or your friends who are inexperienced investors tell you that, I'm a better stock investor than a lot of those so-called professional investors, I think that kind of worries me a bit. I heard of my friends' children who believe they can make a few $100s a day so they don't have to work after graduating. I think that again is some sign of exuberance that you can see in the market. However, the last slide, which I would like to end my presentation with, because I don't want to be termed as Mr. Doom, as in this panel. I think the good news is that if you are prepared for the next downturn or correction and focus on fundamentals, I think you will emerge a bigger winner in the next uplick in the next correction and then the next uplick of the stock market. The good news is the average bear market you have seen over the past couple of decades, they only last quite short for a period of about 1.5 years to 2 years. And then more recently, a lot of the correction has also been much shallower and quicker to turn around. And most of them lasted, just around 100, 110 days. So I think my message to you is just be alert, be aware of the kind of signs of exuberance in the market, and get prepared when the market corrects in a way whereby you see fundamentals appearing, value appearing, then I think it's a good time for you to get back into the market. With this, I'll pass you back to JP.
Yeah, thanks, Kenny, for sharing your insights over the past few bubbles that have happened in the global markets. So I'll just ask you a question on the various examples that you have shared in terms of some of the possible bubbles that you see. You mentioned cryptocurrencies, for example. Many variants there, not all born the same or equal. You mentioned specs as well, and some of the other meme stocks like your GameStop. So, in your opinion, what looks like the biggest bubble right now, and why?
Yeah, I think what is concerning right now, of course, you go to the crypto world. I think a lot of volatility out there. I don't think the cryptocurrency is for the faint-hearted. And secondly, when money gets too easy, you have people investing in what they call the meme stock. They are not actually investors. They are actually stock traders, stock speculators. They hope to make money just by staying through the night, watching the U.S. market. I think those are kind of indication, as I mentioned earlier, that this bubble is definitely going into the mainstream to even a man on the street. So that is something that I think we should be watchful about.
And Kenny, on one of your last slides, you talked about the duration of bear market corrections and how that has become shorter, let's say in the last 1 decade. Are you expecting, a certain correction that could be a bit sharper in the near future? And what should investors like ourselves do when something like that happens?
Yeah, that's a good question. In fact, I'm not here to tell you to try to time the market, because timing the market is really a very difficult thing to do. So what I'm trying to say here is that be prepared. So for example, if you think that there's exuberance in the market right now, have some reserve that you can prepare yourself for correction, and then focus on the basic of investment, which is looking at fundamentals, looking at valuations. So I think that would be the best way, to deal with this market. And to start off with, personally, this is my personal opinion, I think there should be a market correction within the next 6 to 12 months. And I think the catalyst for this market correction will be a reversal in interest rate. And inflation rate, perhaps people think is going to be very transitory right now. In fact, turn out to be much nastier. So that could be some of those, black swan events or indicators that investors should keep monitoring.
Yeah, thank you very much, Kenny.